Thanks for joining us for the MTA podcast with Ralph Acampora. Although Ralph needs no introduction, I'm going to just read a little bit about his biography. Ralph Acampora is the New York Institute of Finance's Directory of Technical Analysis Studies. Ralph's been a pioneer of technical analysis and in the MTA for over 40 years, and he has taught at the New York Institute of Finance for 37 years. Many of Wall Street's best and brightest minds began with a course under Ralph. Before joining NYIF full-time, he was Director of Technical Research at Knight Equity Markets. Prior to that, he worked for 15 years at Prudential as its Director of Technical Analysis, and he is one of Wall Street's most respected analysts and has been consistently ranked by Institutional Investor for more than 10 years. Ralph is a Chartered Market Technician, a designation he helped create and which is now recognized by the National Association of Security Dealers as the equivalent of the Chartered Financial Analysis, which is quite an accomplishment in and of itself. Ralph is also a trustee on the board of the Security Industry Institute. He's currently involved in the establishment of the Security Traders Association University. Ralph, I didn't do your bio justice, but thanks for joining us today.
Thanks for having me, Mike. It's great being with you guys.
If I could, I would just like your thoughts on the current market. I'd like to know what we're talking, because this is going to be archived for a long time. We're talking on July 27th. And with that said, Ralph, can you tell us what you think of the markets here the morning of July 27th?
Well, Mike, the pivotal point, of course, was the March 9th low. And coming out of that low initially, myself and I think quite a few people just thought it was a technical rally, an oversold bounce. And I believed it was tradable but not investable at the time. But as time went by, we're talking about April and May, it broadened out a little bit. It followed through to the upside. Did not get any Dow theory bull market signal because there was no positive non-confirmations on that March 9th low. That same day, both the transportation average and the industrials made new closing lows. And at major market bottoms, you want to see some divergence, which was not present. So I think, as I look back, I still would have said the same thing. I would have said that we had a good counter-trend rally. There was no technical evidence, whether it was in breadth or whether it was in volume, to suggest that we made the final bottom. Now, having said that, I think after that May consolidation, and we had a little bit of a rally in June, and then, of course, everyone saw that consolidation and the rollover in June, early July. In fact, it seems that everyone was talking about a mini head and shoulders. I get very nervous when everybody sees the same pattern. But, it's not what I saw that made me bullish in mid-June and early July. It's what I didn't see, Mike. And what I didn't see was the market coming under a lot of pressure in the face of horrendous news. And every day on CNBC and in the newspaper, you keep hearing more and more bad news about our economy and the prospects of, the expectations of future inflation. So the market, I think, underwent a very, very positive period of consolidation in the months of May and June. And finally, we got a Dow theory confirmation bull market signal when the industrials closed above 8799.26. That was the close on June 12th of 2009. And the transportation confirmed shortly thereafter when it closed above 3404.11. That was the transportation's May 6th, 2009 high. So as those who follow Dow theory understand it, you have to look at closing prices, and you need both averages to confirm. So whether it's Dow theory or the breadth, which is very, very impressive, I'm optimistic.
Ralph, one thing I'd like to point out is that you went public in early April, I believe it was, with these numbers on the Dow theory. You said you would turn bullish if these numbers were hit. And for our listeners, they can go to the archives of the MTA webinars where you did that in early April, and you also have really helped people understand what Dow theory is.
Well, thank you, Mike. And again, when I did that, I was also mentioning very, very much the comment that I just made, that we needed more evidence, but the final evidence was the breaking of those two levels. And I think if you look at the graphs of both those averages, you'll see that we broke through them with real determination. Actually, my biggest fear is that we have a melt up. And I've been talking about that for a few weeks, and people kind of look at me quizzically and say, what do you mean a melt up? I mean something along the line of accelerated parabolic moves in both the averages, in fact, in a lot of individual stocks. And I think that will be caused by not economic news, not even technical news, but something that we have to be very, very aware of. And this is the second half of '09, and many portfolio managers. And I took a trip to Europe a few weeks ago, and I talked to many portfolios managers, and most of them either maybe traded coming out of the March low, maybe. But in the correction in May and June, there was no major desire to commit capital. So I think here we are the second half of the year. I think the accelerated move, or this parabolic move, is going to be fueled by all that cash on the sidelines. And I don't care what anyone tells me, performance is always primary. And now that the year is, I guess, we got about 5.5 months left, the pressure is mounting on these portfolio managers.
Yeah, Ralph, one thing I hear a lot about is volume, how there's no volume on this move, and therefore we shouldn't trust it.
Yes, absolutely. In fact, I think I made a comment of that before on March 9th, and in the rally coming off those lows, that was one of the things that was missing. Even I was a little concerned about that. But now that you step back and you say, you know, what is it really, the lack of volume really reflecting? I think it's reflecting the distrust that so many investors, even professional portfolio managers, have, and the desire to preserve capital. We went through such a horrific decline in '07, '08, and early '09 that most people are willing to sit on their hands, and most people would be very, very grateful just to get close to even or break even. Now, but having said that, and that's the reason why we don't have the rally, but I mentioned a moment ago about that money on the sidelines. I think you're going to see the volume, Mike, but unfortunately it's going to be late in this move, and that's my fear. My fear is that we get the volume towards the end of this accelerated move. I have a potential target of a little over 10,000, about 10.5, 10.7. I think if we get up there and we start to see the volume, that's the blow-off, if you will, and that would be a classic technical term. So those are the things I'm looking for. The volume that I don't see now is actually bullish because it means that there's more money still to come into the market and fuel this thing higher.
So your targets are about where right before where the big break started in October of last year.
Yeah, it is, but I didn't calculate it on that basis. I play a fun game I like to do once in a while. I look at the individual components, and there are only 30 of them in the Dow, and I try to project, technically, of course, what the upside potential for each of those stocks are. And then I do that, I add them all up, and I divide by the current divisor, which is 0.1323, and making two assumptions. Number one, that I'm absolutely right, that all the stocks get to those targets, which won't happen. And number two, that I have to do it simultaneously, which definitely won't happen. So it's kind of like a Hail Mary pass for me. So I based it on the components of the Dow, and I understand what you're talking about, because there's really very little supply between here. And actually, when you get up to around 11,500 is where some of the supply comes in.
Do you worry about just the public being so enamored with technical analysis at this point, where they're looking head and shoulders all the time?
You know, that's a wonderful question, and you're asking the right guy that question. Having lived through the 1960s and 70s, and not just researcher, but actually lived through it, I didn't live, of course, through the period after the Great Depression, the Great Crash of '29. I read, obviously, like everyone else, read about it. And you know what? Technical analysis became famous or became very popular in the 30s. That's when the major technical books came out in the 1930s and 40s. In fact, Elliott came out, I think, in the 30s, and Gartley's book, Harold M. Gartley, and Schabacher's books. So technical analysis became popular after that big debacle, and that's a normal phenomenon. It also became very popular after the 60s and 70s break in the market, when we went through that secular bear market for, 15, 16 years. Technical analysis, it drew more people to its philosophy. And again, now we're starting to see it. And the reason for that is because everything else prior to that didn't work. In fact, today, because of the problems that we all experienced globally, I might add, in the last year and a half, people are questioning the efficient market hypothesis, thank God, finally. And they're starting to question the buy whole philosophy, which is important. They're even questioning diversification, which I wouldn't want to be anti-diversifying. I mean, that's crazy. You should be diversified. But taking all of this into consideration, what helps in a market that's not a buy and hold market? You need a tactical approach. What is tactical? That's technical analysis. So the reason people are gravitating to it is because of the fact that so many of their other tools didn't work, but they're gravitating to because this is what they really actually physically need. Having said all that, my fear is not today so much, but in a couple of years down the road, I think technical becomes the tool that more and more people use. Then I think we start to bump into ourselves, but I won't worry about that today.
Now, Ralph, you actually are one of the preeminent market historians, and you've researched secular bull markets going back into the 1800s.
Yes.
Possibly being one of the few who understands that a bull market was created by canal stocks in the mid-1800s.
Yes.
Do you see a driver like that? And, if you wouldn't mind running through what you saw since canal stocks that drove big bull markets, and what do you think will drive the next secular bull?
Well, I'll give you a little story that happened in 1974. Now, let me bring you back into history. 73, 74, in that 2-year period, the Dow lost 50%. Sound very familiar? We just went through the same phenomenon. I won't give you the name of the client, but one of the largest clients in the world came into my office. Not my office, came in Alan Shaw's office. Of course, they came to see Alan, but I was the little chartist in the back of the room, and this client was so upset. He comes in yelling and screaming, and he said, I just took Avon products from 120 down to 16 3/4. And by the way, Avon Products was a glamour growth stock, the nifty 50, if you will, of the 60s and 70s. And he said, I took it all the way down from 120 to 16 3/4 and never sold a share of stock. He said, I'll never do that again. And of course, he spent an hour or so in the private office of Alan Shaw. And as he came out of Alan's office, and I'm just a spectator watching all of this, and he yells out to Alan, he said, and they said I couldn't buy small stocks. He said, watch me, Alan. This is 1974. Now, let me ask you a question. How long do you think it took that man to unload large positions like his Avon and he had controlled data? I don't know, millions of names in those days. The answer took years. And that was every time Avon would raise its head up, all the cannons would go, and out they would start selling this stuff, and that's the supply. And that's the phenomena that you see, and we will see in the years ahead, because that's why the market will stay in a wide trading range, because people want to get out, get even, and some of these bigger name stocks. Now, I take that same observation, I apply it today, and I say to myself, we had just gone through a big, big decline, and what were the over-owned stocks going into this decline? Now, my answer is financials. So what do you think the stocks they're going to unload when they start to rally? Are the Citicorps and Bank of America? These people are laden with this stock. They want to just get any kind of rally, get out, get even. Okay? Question is where they're going to rotate into. That man in the 1974-78 period was rotating into small and mid-cap stocks, and that was a major glacial move, and that was never done before by a large institution. And that's the beginning of what we all know today as, the secondary stocks outperforming or underperforming large cap. I saw it. I was there when it happened, and thank God I still remember it because I like to tell that story. And to answer your question, Mike, you asked me, what can I see a shift in now? Well, think about it. If you go back the last, let's say, 8 years to 2000, what sector or what group really underperformed in the last 8 years before this debacle? And the answer is technology. Because of the bubble popping in 2000, for the last, from 2000 to 2008, technology underperformed, basically. I think you're going to see money coming out of the financials, and over the next several years, I think they'll be they will work their way into technology stocks.
Wouldn't that continue the last bull market then?
Well, it'll give it, it'll continue a bull market, but it'll be concentrated in certain areas. And I still think, like so many technicians, that, we're going to be in a wide trading range for the next several years. So these rallies that we have are really cyclical bull markets. And, I think the technology leads in this one, and then it backs off a little bit, maybe it picks up the next cycle up. But I only bring it up because this is an area that was underowned, underloved, coming out of the March 9th bottom of this year. But one other thing I want to stress when it comes to rotation and leadership, I think the U.S. market, and we'll use the S&P or the Dow, doesn't make any difference, will always give the world leadership. No, excuse me. Will always give the world, I don't mean to use the word leadership, always give the world direction. Because if the Dow is not, or the S&P is not going up, I think most markets around the world will probably follow suit. But I think when it comes to leadership, that's direction versus leadership, I think you really have to look globally. And China, and maybe India, maybe Brazil, some other of those emerging markets definitely have leadership characteristics that the U.S. market and even Western European countries do not have. So I think when we're talking stock markets, we now have to think globally.
Is this possibly similar to what we saw with Japan in the 1980s?
You mean with the U.S. being Japan?
No, the 1980s when Japan led the way up.
Oh, okay.
Similar to China.
Yeah. Yes, I think that's a pretty good analogy. Yes, I think, but unlike Japan, I don't think I see the other side of it. Although China will have its problems. I mean, everybody does.
Yeah, I think year to date, China's up about 80%, so I don't think a pullback would be unexpected. But again, I mean, it's going up and GDP's growing.
Absolutely, and it doesn't have the same problems, financial problems with their banking system as we did. They weren't as exposed as we were. No, they have a lot of things going for them, not only technically but fundamentally and economically.
Yeah, and I think Brazil is the laggard in the group that you mentioned. They're still up 40% year to date.
That's right. So I'll repeat myself. The Dow or the U.S. market will give direction, okay, but not necessarily leadership. And if you're in the performance game and you want leadership, then you have to expand your horizons and definitely look global. Oh, by the way, one more thing. This word decoupling that came up over the last few years, I think in the early part of this new millennium, I totally disagree with decoupling. We all need each other, and I think we technicians are going to start coming up with new indicators. So maybe there's an international Dow theory. I'm trying to work on one where we can find a transportation index. Maybe it's the dry goods. Maybe I don't know. We have to look at the movement of goods that connect not only the U.S. but other Western nations with China and expanding nations. It'll be a good study.
There are those who argue that Dow theory is outdated because the transportation average and the industrials don't really reflect the economy. You seem to disagree with that?
Oh, I totally disagree. But for as long as I've been following Dow theory, and that's over 45 years, I always hear, the Dow theory is passé. The last time we fought that battle was when the transportation average actually was originally called the railroad average, and it was a few of us in the MTA. In the fledgling days of the MTA, we went to the Dow Jones Company in 1969, 1970, a couple of us, and we knocked on their door and told them that they had to update the average because you needed transportation needed more representation, just railroads, and so they put in airlines and truckers. I like to believe that we were part of their changing that average. And today, when people tell me, "Oh, well, the railroads are meaningless," or the average has less meaning, I defy those people to start looking at the railroad industry today. The railroad industry today, I think, is as important today as it was 100 years ago. In fact, there's more money being spent on modernizing railroads and making them bigger. They have to haul this stuff to the West Coast to ship it to China. And when the Chinese export stuff to the United States, how do they get it from California to New York City? Railroads. The railroads are a huge industry. By the way, I would put that in the category with technology as an emerging leader. I love railroads. So it backs up my story with doubt theory. No. It's a time-honored, wonderful old theory.
Yeah, I think it also backs up your historical research where you found trains led a bull market in the late 1800s. The automobile led a bull market. Yes. Every major advance in transportation has led to a bull market like we saw in the late 1900s.
And then in the 60s, it was airlines. Yes.
So it's just a recurrent theme, and you don't see a problem with it despite...
Not at all. Not at all. In fact, it's coming back to the railroads. Warren Buffett bought a big position in Burlington. That man's not stupid. He knows what he's doing.
Speaking of, Buffett and the fundamental side, the fundamentals in some of those emerging markets is actually more compelling than the fundamentals in the U.S. market.
Absolutely. I think we're going to look back. You know what? Technical is doing its thing, Michael. It's telling us that the leadership is there. Now what we should be doing is putting on our fundamental hats and find out why. And I think that statement you just made is one of the reasons why the technical of these markets, the price action of these markets, is leading the fundamentals, which it should do always.
And technicals do write tomorrow's headlines.
Absolutely. That's why we love it so much.
It's a lot easier from our perspective.
Yeah.
Ralph, I've taken too much of your time, and I thank you for sharing with us today.
No, that was fun. I enjoyed it, and hopefully we can do it again.
Good. I hope to catch up with you in a few months, maybe nearer the top of this run.
Yeah, let's do that. I think it'll be very, very timely.
Great. Well, thank you, Ralph.
Thank you, Michael.